Well, we are seeing some positive action in the market this morning. Inflation signs have been encouraging this week. Today, we talked about some of the retail sales data being encouraging for U.S. investors. And then if you think about where we've come over the last week, after a really choppy, volatile, worrisome, whatever you want to describe it as, start to August, we are definitely clawing our way back here. Let's get some more perspective. Carol Schleif, Chief Investment Officer at BMO Family Office. Carol, great to be with you. Not that August isn't a time for more choppy performance historically, but I think everybody got a little bit jittery as we started the month. What has changed in your opinion?
I think maybe mostly what's changed is just consumer or investor sentiment. It was more than a bit of overreaction to that payroll report a couple of weeks ago. But a piece of that is because you've typically got lighter volume, you've got spottier coverage on trading desks, you had some different trades that needed to be unwound. So there was a lot exacerbating what shouldn't have been as concerning a single data point. And I think the data points we've seen since then really confirm that the inflation is coming down, the consumer remains strong, though picky and choosy about where they're putting their money, and you've seen that illustrated in some of the individual earnings reports that we've seen. So it's really, I think, at the bottom line is we've got a highly functioning economy that handled the dislocations presented by the COVID pandemic quite well.
And look, at the end of the day, the stock market affords people all sorts of opportunity. If volatility enables you to make some moves faster than others, you can go for that. A lot of people are in it for the longer term, and I think the fact that we saw a lot of ups and downs last week, but in a lot of ways the levels now look very comparable to where we were a week ago, is a reminder that time passes, and ultimately the stock market over time has generally been a pretty good performer. A pretty good performer in environments like this as well, when everybody is talking about a transition towards lower interest rates. I suggested you would not be surprised to see stocks grind higher. Can you give us a sense on what you're going to be thinking about when it comes to the equity market performance moving into the fall?
We do think that there is an opportunity, or there is the likelihood that we'll see more volatility. You've seen a lot of volatility in the short run, not just last week, but over political outcomes, over geopolitical outcomes. If things heat up rather than cool off in the Middle East, you've got the potential for interim volatility. But it does speak to the fact that having a diversified portfolio and sticking to your proverbial guns and staying put helps, because if you're out of the market or out of a particular asset class during those violent moves that we see, you can miss the bulk of the upside and it gets to be too late to get back in. You don't always get an opportunity. So if you look at some of the moves that we've seen in emerging markets or in small cap stocks where the bulk of the move comes in a week or two, if you're not already positioned in that, it means you miss out on big chunks. So having durability built into the portfolio can also mean having some fixed income in there, which performed very well when the equity markets were difficult for those couple days.
Okay, and that's helpful context, of course, lessons learned over the years. You mentioned a couple of different equity asset classes there, though. I think that the question in an environment where interest rates are coming down is, what are the kinds of sectors that might be poised for better performance, maybe in the shorter to long term from that? Can you just walk us through areas that you think are beneficiaries, assuming the Fed cuts rates and continues to do so into next year?
Sure. One of the areas or several of the areas to look at would be those that are most benefited by reducing rates. It would be lovely to see some of the particular consumer goods companies that feed into the housing market. It would be lovely to see some of the real estate markets move on that. And from a capitalization standpoint, small caps are on average more heavily indebted with some floating rate debt. And so lower rates would benefit them, that category, small and mid cap, and many of the companies that are domestically focused on that as well. That said, we still continue to believe that between medical technology and technology in general, that artificial intelligence build out, the infrastructure build out, and the vast move that we've seen to bring manufacturing back to the U.S. is going to benefit those segments as well.